We end in the year 2025 with the Federal Reserve announcing a new QE of 40 billion monthly for the market, which could trigger a new bullish cycle on 2026. But the question is, if the new presidency of May 2026 for Federal Reserve change the plans? Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to give you a fresh update about the Federal Reserve and the monetary policies in the United States, the biggest central bank in the world. We are going to face a recap of the whole year and also what could be the next scenario for 2026, not only from a macroeconomic perspective, but also analyzing certain assets as an equity and forex market in United States for the coming months, and also estimations what could be the next steps of Federal Reserve. Before we go into details, please let me remind you, if you are not subscribed to this channel, you should click on the subscription button and click on the bell if you want to receive fresh updates anytime we make new reports. Going to the presentation, we want to analyze the situation of the Federal Reserve for the whole year, what was the scenario, and also what could be the coming concerns on the Council of Federal Reserve. The main thing we want to highlight here is that from January to July, almost half of the year has been an on-holding position from Federal Reserve. They didn't cut the interest rates during the first 7 months of the year. They seems to be more concerned about inflation and potential inflation also derived by tariffs and the trade war of Donald Trump, which so far didn't happen. The inflation rate in the United States remains stable and even lower than expected. That's why by September 2025 they started to cut the interest rate by 25 basic points. In October they did again another cut of 25 basic points, and finally in December they did what some analysts considered the last one, 25 basic points. It was called the Hoax last cut interest rates, not only for the year but mainly for the coming year 2026 as well. However, we believe that that could be not the case, and a new Federal Reserve could emerge by half of the 2026 with a new presidency. Let's go into details. Jerome Powell, what was the comments he did? He said, our two goals are a bit in tension. Risk to inflation are tethered and to the upside, and risk to employment to the downside. The main two concerns he has. We need to admit also that during the October, the government of the United States was closed, and therefore the collection of data to analyze what is the real situation, either of inflation, either of the labor market, is gone. They admit they don't have all details, all data to analyze what is the current situation of both markets. That's why they are still concerned about the tariffs of the United States on third countries, which is mainly the trade war by Donald Trump. It could cause inflation, it could cause future inflation, but they are also concerned about labor market. Focus on risk to our employment mandate, giving underlying inflation trajectory towards 2%. Well, so far it seems to be the case, but again, they are not 100% sure that inflation is going to keep going in that direction. Now, one important point to highlight here is the Council of FOMC, the Council of Federal Reserve, the FOMC, has this time in December, during the last cut of 25 basic points, they got 4 members who voted against the December cuts, which means unprecedented opposition reflecting deep disagreement over policy direction and mandate priorities. The main question is, if by May 2026 next year the presidency of Federal Reserve is going to change, is the new president in line, or these other members of Federal Reserve going to change the position they have on monetary policies because they change on the head of the institution, or they're going to disagree with future interest rate cuts? Policy pressure. Trump seeks to reduce power of regional Fed bank presidents. A new Fed president take office in May 2026, and this is another very interesting point. We have seen during 2025 how many economists were suggesting that Donald Trump was actually putting a lot of influence on Federal Reserve, or try to force Federal Reserve in many directions. We have seen really funny comments coming from the US president to the Federal Reserve and the head of the Federal Reserve, and that's the main reality right now of the situation. Presidency of the United States who is trying to influence and take the control of Federal Reserve, and that could change in the future. future. That uncertainty, as I said, during the lockdown of the government, we miss a lot of numbers that could make better, more accurate picture of what is the macroeconomical situation of US economy at the moment. And reviews Q3 figures right this week. We reviewed the Q3 growth rate of United States economy, updating the number from 3.8 to 4.3%, which means the US economy is not actually weak, it's actually stronger than we expect. Looking ahead, conflict of signals. We have a deflationary forces, cooling labor market, which is the reason why they cut the interest rate this time. Apparently, the labor market is getting weaker. The unemployment rate is rising to 4.3%, and therefore it's a good reason to cut the interest rate. However, it's also true that the new Q3 review by 4.3% growth rate doesn't seem to be an economy in problems, and therefore doesn't seem to need more interest rate cuts. Also, less migration means higher labor cost, and the previous inflation for the last 2-3 years was caused by labor cost mainly. You can analyze this by deaggregating the composition of inflation in the United States. With this factor of less migration means higher labor costs, and therefore it could mean future inflation coming to the United States on the top of the potential inflation caused by the US Donald Trump tariff. Federal response, officially buying assets again. This is the new QE, announced of 40,000 millions of new assets buy by the Federal Reserve to include in the balance sheet of Federal Reserve. It is a QE, and therefore is a continuous stimulus of the market. Keyway, the Federal Reserve restrictive stance reflect genuine uncertainty with inflation somewhat elevated. Well, now I will say the key factor here is the Federal Reserve finally has changed the policy, and now if the QE of 40 millions is coming in place, we will see the balance coming up. Now I want you to analyze and also see that anytime this balance is rising and the assets are getting back into the Federal Reserve balance, means more liquidity is injecting on the market, and therefore it's super bullish for equity market and also for fixed income market. That's why we believe this shoulder head shoulder inverted in the last week of December 2025 could be a signal of a bullish market coming following the Federal Reserve optimism. Dollar index, in that case we are not expecting a strong dollar, and therefore a dollar downtrend continuation, moving the dollar index below to the current levels. And also in terms of the other assets, we also have in this case a euro dollar that seems to be bullish, again breaking up the whole downtrend, and therefore potentially moving to the next level, which is 1.24 euro dollar. And in the case of cable, pound against the dollar, we also can see that the downtrend has been breaking out upwards, and therefore a new movement to 1.4275 or even 1.49 in the near future, in the coming months, could be the next level to reach by pound against the dollar, which in both cases means a weaker dollar because the Federal Reserve is refilling the balance with new assets, supporting also the deficit from the United States by new Treasury bonds to the US economy, and therefore generating new and fresh stimulus for the US economy. Well, that's all. I hope you enjoy this report and give you a clear picture of where we are and what could be the coming steps for Federal Reserve. See you in the next videos. Bye bye.